Hi, everybody, and welcome along to the Mint monthly update for the single sector funds. Today, you've got myself, David Fyfe, and fellow portfolio manager John Middleton to run you through the month of August that was. Just flicking through. I thought, just as a few charts of interest, something that I've been reading recently, I thought was quite a interestingly and worthwhile document to have a look at is actually the report done by the IMF looking at New Zealand's productivity. Now, this is a topic that gets talked about a lot and something we're usually quite conscious of in New Zealand, that our productivity versus our OECD peers is quite poor. And a couple of charts here I thought were interesting is if you look on the left, this is the capital stock per hours worked in New Zealand being the red line trending to the bottom. And this is sort of indicating that effectively, while we're bringing more people in and the GDP growth we've seen historically in New Zealand has been driven by people, it's certainly not been driven by capital efficiency and spend. And it is something that, as a smaller nation with what is somewhat a higher cost of capital in general, we do see a lot less spend in capital goods, whether it be through technology or all sorts of different manufacturing enhancements. We've not seen that over time, and it's always been a strain. And then the other one on the right, in terms of investment in R&D, this is something where, as you can see in the chart, we do lag a long way behind our peers. And then I guess that comes from a few different factors. We don't provide a lot of incentives. And as I sort of touched on before, being a country with sort of higher costs of capital through both debt and equity markets as well, that does put a strain on a country that is very skewed to SMEs and smaller businesses. So the willingness and ability to spend more on capital and take big investments and I guess create unicorn companies, which is all what we see offshore, just doesn't happen in the same way in this part of the world. And I guess the other interesting thing, not just the negative side of it, but actually just what were the suggestions in terms of helping to solve some of our productivity issues as a country. There's a few different ones. One of them is actually to deepen capital markets, and that can be done through all sorts of areas, through both our debt and capital markets. And interestingly, I think that is something that we're sort of seeing from politicians and government around, already seeing some increasing in KiwiSaver contributions to help support, and that helps fund as well in terms of capital in different markets, whether it's infrastructure as well. So that's sort of some steps in the right direction. And then, of course, it's boosting innovation. And we did see the tax incentive recently in the last budget as a small step towards that. So I think it's something that the current government is certainly aware of and moving on, but it is a slow fix either way. Now, just moving over to the month, in terms of the equity markets in New Zealand, they are up a fraction, just 0.8% for the month. And in general, for our funds and the New Zealand locally fund as well, it was challenging. It was certainly volatile, and I think John will touch on a bit more of that later on. Sorry, but in terms of the results themselves, they were skewed to a negative set of numbers for the results. I think when you actually look, even some of the revisions and outlooks were quite soft too. And the chart I've included there is a great one that Forsyth Barr just published recently, showing you what the earnings revisions were post-reporting season versus actually the share price movement relative. And actually what you found is that while there were some somewhat negative numbers, so much of that was already priced in, that expectations were low, that actually share prices didn't sell off aggressively. So, some may say, are we at the bottom? For some companies and sectors, it does feel that way. But are we improving rapidly, and are we seeing sort of confident outlook statements? I think the answer for us is not yet. In terms of the stocks that performed well through reporting season, some that didn't. I mean, there were two big ones really, and one was EBOS. They had a bit of a shocker, and John will touch on that in a bit more detail. Certainly surprised. It has been a traditionally well-held stock. And we were no different on that one. But the one that really did perform well, not on the day, but a few days later, was A2. Now, they continue to execute very strongly in China with their infant formula product. The wee surprise, but wasn't a complete surprise, you'd say, was the announcement on the day of the result around the acquisition of the Pocono site from Yashili to help them, I guess, vertically integrate their supply chain and, I guess, add the margin over the medium term as they look to succeed in China. But at the same time, they managed to sell their rather less successful acquisition from a few years back of MVM down south. So net, it was actually a reasonably solid outcome across their business to secure their future. And in fact, they continue to perform well in a softening or soft Chinese formula market. But what we're seeing over there is certainly a skew to the English label product. They were up 17% for the year, for the half, sorry, on that, and it continues to perform really strongly. So we continue to keep a close eye. I think the main issue from A2 from here is, given its success and given its recent rally, is just really the valuation. There's certainly a lot implied at the current share price in terms of market share gains, of which I believe a lot of that was already sort of forecast in within analyst numbers. So certainly some high expectations on this company going forward. Outside of A2, a couple other names I'll touch on briefly. We did see Scales, one of the names in the fund, do rather well. Had a great year for horticulture in terms of apples, great size, great pricing, and has done very well, and that certainly beat expectations on the result. Their other core global proteins business did okay, reasonably flat, but again, they've got some other assets out there that are sort of in work in progress at the moment. And in terms of their Media Australia, we saw some great outcomes there. Their key Shelby asset in the US, they're relatively flat, but hopefully, once we see the softening of some pet food outcomes within the US, that should tick up in the next while. What we did see, though, from there was their logistics business do particularly well. That was through sea and air freight, partly in the dairy industry as well. So they did very well from the higher volumes going through the wider business. So that was a great little win. And outside of that, one of the other names that we've been underweight in this fund has been around Fletcher Building. Was a rather soft update. Again, somewhat well expected, but certainly no green shoots in terms of outlook. They're talking another year away before they believe they'll see that. And again, unfortunately for Fletchers, we did see some sizable one-offs that did sting that bottom line, so it wasn't particularly pretty. In terms of looking forward, though, next week we do have the Infratil Investor Day. That's one of our sort of key holdings, looking to get an update on their data centres, what we'll see around contracting there, as well as an update on Long Road and some of their development assets. So I'll be interested, and we'll report back next time what they talk to. So I'll now pass over to John to touch on the Trans-Tasman Fund.
Thanks, Dave. Yeah, looking at the Australasian Equity Fund, as Dave alluded to, a tough month for the fund. I think we did get a couple of runs on the board in terms of reporting season, but a few things didn't go our way. Arguably overdone in our view, and I'll come on to that. But it was a difficult month. In terms of what did go right, well, the good news is, SRG delivered a solid result, continued to grow ahead of expectations. I think we've talked about it in the past, but basically, an infrastructure play with tailwinds. Essentially, its positioning in things like dams and facades and other areas means that clients keep on knocking on its door, and it continues to grow ahead of expectations. So a good old-fashioned beat there. Also, Charter Hall, again, one of our few names held in the property sector, but had a decent result and essentially continues to pick up fund flow in what looks to be a rebounding Australasian or particularly Australian property market. And then finally, Channel Infrastructure, again, another solid result with growth coming through ahead of market expectations. On the negative side of the ledger, it feels like Telex can't win a trick at the moment. Essentially, we got an update from the company highlighting the fact that basically an isotope manufacturing business that they bought probably about 6 months ago now, the impact on underlying earnings would be more than we expected. This is a slightly atypical acquisition for a growth company like Telex. Essentially, it's all about the revenue line. For whatever reason, or for solid reasons earlier on, they decided to buy the ability to manufacture, which increased their defensive moats and secured their supply. Clearly, the cost of manufacturing in a high growth biotech business was a little bit more than the market had expected, and caused a bit of a downgrade. Although longer term, we don't think that really undermines the value of the number of products coming to market over the years ahead. So that took a knock on top of a couple of other things which have not quite gone its way. In addition, one of the new products was delayed as the FDA asked for further information, and in what was a pretty brutal month in terms of punishing things that went wrong, it did go backwards again and weighed on performance. The other stock I sort of call out would be EBOS. Again, high quality business, strong track record. Essentially, it was the first set of results delivered by the new management team, both a new CEO and CFO. And the short answer was the numbers were lower than expected. We've been sort of thinking about losing the Chemist Warehouse contract basically almost a year ago now for a number of months. Certainly the performance in the first half would have appeared that we'd weathered that pretty well. But in the second half of the year, there were increased costs, in particular leases, etc., that came on, which we weren't really expecting, which resulted in a softer number than we'd expected. And I think that coincided with new management, the market worried about things which we think are probably overdone. I mean, the reality is, I think that Australian pharmacy market continues to grow well and is well supported by government in terms of pharmacy funding, and actually the other two parts of the business, institutional healthcare and the animal care business, again, broadly delivered in line with expectations. So, clearly it was a knock on the day, and we'll take a bit of time to rebuild confidence. But I don't think that really undermines a business which has got a long-term track record for solid growth, and we've basically maintained our position. Hopefully the slide on the right highlights the volatility of the market over the last month. This is a chart we borrowed from a Wilson's update, really looking at various Australian results, and in the red or the pink or orange basically is what happened to earnings, and the blue is essentially what happened to the share price. And I think it highlights quite well that basically beats were rewarded probably more than they should have been. And again, you'd flag things like Westpac. Westpac is probably one of the weaker of the banks and certainly has a number of structural issues. But its new management team delivered a set of results which was actually pretty good, and it was rewarded with about 10 to 15% share price outperformance. Bearing in mind the banking sector's actually had a very good run over the last year or so, notwithstanding. So, again, probably an outsized positive return for Westpac. Similar story for Brambles. Again, high quality business, solid results, touch ahead of expectations, but up 10% as well. And then on the flip side, probably the standout result in terms of negative was James Hardie. It's actually something we exited a while ago, but last time they sort of spoke to us, they announced a deal that looked to be buying an expensive business at the peak of the cycle, and raising equity to do so, which now went down pretty badly. And then they updated us with a sort of a quarter performance which was weak and highlighted issues within the US market, and particularly slowing spend rates. So, that was punished pretty aggressively off 30%. One of the stocks we own in the fund, CSL, actually delivered a set of numbers maybe 1 to 2% below expectations, and talked about selling its flu vaccine business, and investing more into, or basically reducing their investment into R&D going forward. To be honest, looked reasonably sensible things to do, given various issues, but the market didn't really enjoy that very much, and it was off 20%. And obviously we talked about Telex and the earnings move and the share price move there. So overall, a pretty volatile month. Again, our view is that a number of these moves are overdone, and again, we still remain invested in high quality businesses with good growth prospects going forward, and we hope that will sort of even out over the months ahead. Moving across to the property fund, actually delivered quite a solid performance in the month. Again, Charter Hall was probably the standout, delivering a strong return, but also the overweight in Kiwi Property Group paid dividends, as did the underweight in Vital Healthcare. One essentially stood still in the month when the sector had another solid month, as we've talked about before. On the negative side, I mean, not too many negatives, but Goodman Group probably treaded water, which was a little bit disappointing. Again, interesting to see it's basically traded sideways for 6 months since the capital raise, while the sector has sort of been re-rated As we've talked about before, basically, I think the market's going after yield, and certainly the Kiwi side of the sector offers a pretty attractive yield, albeit again the sort of the yield is reducing as the share price goes up. But generally a solid month for the fund. Hopefully the slide on the right sort of continues our narrative on what the sector has been doing. The interesting thing is the sector has had a strong few months, and particularly the higher quality end of the New Zealand sector is now trading broadly in line with book value, which I think is probably fair, but leaves limited upside, I would say, from here for those three names, which are Precinct, Goodman and KPG. At the other side of the sector, the smaller sort of mid-cap names, have re-rated well as well, but remain at discounts to NTA and arguably offering high dividend yields. And so, during the month or the last couple of months, we've taken a little bit of money out of the quality end of the sector and put that to work in the lower end of the sector. But the reality is, I think the big re-rate for those stocks has already happened as well. But good to see that the property market is benefiting from that chase for yield. We've talked about it in a few guises and forms before, but the fact that term deposits are now offering you materially lower returns than the yield for the property sector, and certainly certain property names are offering a much higher yield. I mean, I think the retail side of the market has moved to replace term deposits with reliable dividend yields out of the property sector. Anyway, I hope that was of interest and useful. As usual, if you do have any questions, please drop us a line at info@mintasset.co.nz. We appreciate your support and look forward to talking to you in a month's time.